I have never blown a funded account. And by the way, I've got 5 of them. Now, there's 2 main reasons that I've never blown a funded account. 1 is my psychology, and 2 is I manage my risk very well. So today, I'm going to use this whiteboard, and we're going to talk about how I manage my risk so that you never blow a funded account either. Or at least you're a lot less likely to. Now, I don't know if you're going to be able to read this, but I'll do my best, but my handwriting is terrible as a disclaimer. But we'll talk about evaluation accounts first. Now, for evaluation accounts, we're going to use the example of a 50k account. And by the way, I will trade evaluation accounts a lot more aggressively than I'll trade the funded accounts, as you probably should do. If you have a firm like TopStep, you'll have $2,000. Or if you have a firm like Bullanox, you'll have $2,500 on a 50k account. Now, the way I approach a 50k account with an eval is I will do 1% of whatever the actual account is. So if it's a 50k account, I will do 1% risk of $50,000. Which is $500 of risk. This is for an eval account. And that obviously means that if I am paying for something with a higher amount of drawdown, so 2,500, it gives me a little bit more of wiggle room because I don't have to lose as many trades to lose the account and have to reset it. And then I will just keep my risk on an evaluation account at $500, and I will just keep going until I pass the account, because obviously I want to get it passed or failed fairly quickly, so then I can just reset. If I fail or if I pass, I can move it into a funded account that I can actually make money from. So now we're on to funded accounts. Now, the way I manage my risk on funded accounts is a little bit more complex. It's not rocket science, but it is slightly more dynamic than an eval account. So you're going to use the same account of a 50k account. And again, you'll have either $2,000 or $2,500 of max drawdown. So then what I'll do for that is I will do 10% of whatever my max drawdown is. So if I have an account with $2,000 drawdown, I'm using $200 risk. And if I have the bigger amount of drawdown, I'm using $250 of risk. And that risk is what I will use if my account is at all-time highs. So if my account balance is as high as it's ever been, that is the risk that I'm going to use. So to recap, I will use 10% of my max drawdown when my account is at an all-time high. And then this is the simple dynamic approach I take to my risk for my funded accounts. If I lose a trade, half the risk. So we go from 10% of drawdown, which would be $200 or $250 depending on your account, to $100 or $125. And then that is where it stays. I did mess around with halving it again if I lost again, but that just becomes too impractical with a 50k account at least. You could take that approach if you had more drawdown available, but for a 50k account, you probably won't. And then this is where my risk stays until I recover the loss. So if you have a profitable strategy and you just trade your strategy, your account balance is going to grow exponentially like this, because as your drawdown increases, once you get past the buffer, then you can start to risk even more beyond the initial risk that we mentioned in this video. And then when you lose, your account is going to go like that. It's going to flatten out, because as you lose, you are risking less and less, and as you win, you are risking more and more. This obviously assumes that you've gone beyond the buffer that you need to create first, because before you build that buffer, you aren't able to increase your risk beyond your max drawdown because it's still chasing you. So your account growth is going to be a bit more linear to the upside, but still exponentially smoothing out as you lose trades. And then once you're at that buffer that we mentioned before, then you can obviously start to risk more, and that's where it becomes a bit more exponential to the upside. But that's everything I want to talk about as far as risk management for an account. If you follow the simple steps I put out in this video, you will blow a lot less of your funded accounts. So if you enjoyed and you learned something, then of course I'd appreciate a like and subscribe. And if you want more of an insight into the psychological aspects of trading, then check out the video above the whiteboard right now, because I'll talk about exactly that. That is all I have for you in this video. I hope you enjoyed and you learned something, and good luck, good trading, boys. Catch you later.